Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We need to dive immediately into the bizarre recent price action surrounding energy stock, URG, because this name has just strikingly decoupled from the overarching uranium supercycle narrative. I mean, URG has posted a painful sector-lagging minus 14.8% performance over the last month, while many of its peers, notably Uranium Energy Corp, UEC, actually managed positive momentum up 3.4%.
Bizarre is absolutely the right word, but I think the cause is anything but mysterious. The market reaction to that December 10th announcement for the convertible senior notes was immediate, and it was violent. We saw a single-day 13% depreciation, and it was fueled by an explosive 75.1 million shares traded just on the pricing day. I mean, that volume alone tells you everything you need to know about the market shock this financing caused.
Well, that shock is precisely what we need to unpack. The central question for sophisticated investors right now, I think, is whether this steep price decline is due to temporary, purely mechanical forces, driven by the capital markets event, or if it signals something deeper, like fundamental issues with management decisions and, frankly, corporate governance.
And I'll be arguing that the structure, the timing, and frankly, the optics of this financing reveal some pretty significant corporate inefficiency and just flawed capital management. These are self-inflicted wounds that I believe fundamentally outweigh the positive macro tailwinds that RG should otherwise be capitalizing on.
And I'm going to contend that the current depressed price is nothing more than structural noise. It's a temporary product of institutional arbitrage, and it is not a reflection of the company's excellent operational fundamentals. We're seeing real growth. You've got the Lost Creek ramp-up, the future Shirley Basin development. I mean, that's set to nearly double URG's projected EBITDA by 2027. This is a technical trap, not a structural failure. My position is that the stock's current, let's call it technical indigestion, is completely decoupled from its operational success. Look at the balance sheet. I mean, operationally, the company's hitting its marks. In Q3 2025, they dried and packaged, 93,523 pounds of U3O8? Analyst models are based on the future growth. It's all centered on the Shirley Basin development, projecting EBITDA to jump from about $37 million in 2026 to almost $70 million in 2027.
So the thesis is sound. The immediate price suppression, though, is purely technical. It's driven by the $100 million convertible senior notes offering.
Okay, but explain how that debt leads to this massive sell-off for those listening who aren't, specialists in convertible debt.
Sure, certainly. So the immediate mechanism is driven by the qualified institutional buyers, the QIBs, who purchase this debt. Now, to hedge their long position in the bond, they have to implement what's called a delta-neutral strategy. This just means they are actively and immediately shorting the common stock in a very calculated amount to neutralize their exposure to price changes. They're just trying to lock in their arbitrage profit, regardless of which way the stock moves. And the forensic data proves this is happening. Off-exchange dark pool short volume surged to constitute over 56% of total volume in early December. This is institutionally managed price suppression. It's a classic arbitrage hallmark, and it's a temporary consequence of the deal structure, not a statement on the company's future.
I understand the technical mechanism of the shorting. I do. But that explanation completely overlooks the cost and the long-term risk this structure introduces. I mean, sure, the macro-strategic context for uranium is strong, but management's recent decisions have introduced material, long-term risks and high, I would argue, unnecessary costs that really undercut the bull case. First, the financing event carries substantial potential dilution. We're talking somewhere between 15 to 18%, which equates to roughly 57 to 69 million shares. Upon conversion, that's a massive future supply overhang. But here's the truly alarming part for me. It's the price URG paid to avoid some of that dilution. They spent $13.9 million, which is over 10% of the net proceeds, on something called the capped call transaction. For listeners, this is essentially buying an extremely expensive insurance policy from a major bank. It's a complex form of financial engineering designed to mitigate dilution, but only up to a stock price of $2.72. For a company that reported a substantial $27.5 million net loss in Q3, spending $14 million in cash up front on a dilution hedge rather than putting it directly to project development, while it raises some serious immediate questions about efficient capital management.
I see the immediate sticker shock from the $13.9 million fee. I get that. But let's look at the technical challenge presented by the $1.73 conversion price. You correctly identify that this creates a technical resistance level, what we call the ARB wall, because those hedgers are compelled to maintain short positions near that threshold. But to argue this wall is a long-term problem fundamentally ignores the operational and valuation data. I mean, analyst consensus price targets for URG hover around 250 and higher, and that's driven entirely by net asset value expansion from Lost Creek and Shirley Basin. The stock is currently trading below its 50-day moving average of 133. That disconnect proves the stock is fundamentally undervalued. The 173 wall is a temporary technical ceiling that strong execution will eventually breach.
I'm sorry, but I just don't buy that it's temporary. I think that fundamentally misdiagnoses the nature of this arbitrage. Let me tell you why. The arbitrage dynamic turns that conversion price into a persistent structural supply overhang that will not simply evaporate on a whim. These institutional investors, they are required to defend that conversion price to lock in their profit. And we have the evidence, the persistent 52 to 60% dark pool short volume ratio. That is the institutional market continuously pressing down on that ceiling. The theoretical fundamental value means very little if the stock cannot technically break through this hedging mechanism that the company's own financing decision created. They built a technical headwind that limits upside momentum for years.
Okay, but even if we accept that the technical suppression is stubborn, we have to remember the reason for the financing in the first place. They secured $100 million in capital, which was a necessity for accelerating the Shirley Basin project.
Let's pivot back to the core issue, though, the efficiency of that capital raise. I maintain that the $13.9 million capped call expenditure was grossly inefficient. I mean, this is cash that could have been used directly for crucial project development, given the stated use of proceeds was for Shirley Basin CapEx. This massive upfront expense, rather than a simple clean equity issuance, directly contributed to the market discounting the company's already concerning cash burn. The market punished the sheer inefficiency and high cost of setting up this hedge, which signals that management prioritized complex, costly financial engineering over straightforward, project-focused capital allocation.
I think that's an overly simplistic view of the capped calls function. You're focusing on a short-term cash outlay without acknowledging the long-term structural protection it purchased. The capped call transaction was a pragmatic, strategic move designed to neutralize dilution up to 272. What this signals is that management has high conviction in a moderate rally over the next 5 years, and they were responsibly trying to protect existing shareholders from excessive dilution during that rally. And crucially, it bought the company a full 5-year runway. Maturity isn't until January of 2031. It secured the funds needed for Shirley Basin. It was costly, yes, but it bought security, stability, and time. 3 critical elements for a junior producer ramping up in a volatile market.
Security at what cost, though? $14 million is an enormous expense for a company that had a $27.5 million net loss the previous quarter. That's cash that's now gone forever, spent on protecting a future scenario that may be years away. I mean, to me, this reveals a fundamental misunderstanding of how to manage a junior miner's balance sheet, where every single dollar should be leveraged toward asset development.
We have to separate the noise from the signal when we analyze market sentiment. Yes, retail sentiment on social platforms has turned bitter, deeply skeptical, and that was absolutely exacerbated by the insider sales. I'll grant you that. But the directional risk is limited. The true directional short interest, the people actually betting against the company's survival, is only about 3.6% of the float. The vast majority of the shorts we see in the dark pool data are those hedged bondholders, just fulfilling their arbitrage function, not directional bears. This low directional short interest actually signals that institutions are not betting against the company's fundamental thesis. They're simply monetizing a difference in the cost of debt versus equity.
Okay, I want to stop you right there. Because I think focusing on directional short interest completely misses the point of the hedge. The persistent negative retail sentiment, exacerbated by those November insider sales right at $1.27, $1.29, has eroded the crucial retail bid. And retail capital is demonstrably fleeing this kind of single stock risk in URG and moving towards sector ETFs like URNM or URA to avoid exactly this kind of dilution event. The retail investors would drive the momentum you need to break an arbitrage ceiling. Without them, that 173 wall becomes impenetrable. And on the technical side, the loss of this retail confidence is showing up in the charts. The stock is currently trading below both its 50-day moving average, which you mentioned at 133, and its 200-day moving average. This reflects a slow bleed that risks a potential death cross if support at that 115 to 117 level fails, and that indicates accelerating bearish momentum that technical traders will not ignore.
Right. And before we conclude, we should briefly confirm one critical point just to manage investor fears and clarify the dilution risk structure. The persistent rumor of a reverse stock split is false. The source material confirms URG has never executed one since its inception, which distinguishes it from some of its peers. The risk here remains purely dilution of existing shares, not share consolidation.
That is an important distinction to make. The problem is generating too many shares, not that the existing share count is too high. The risk is supply, not structure.
So to summarize my position, URG remains a deeply leveraged bet on the uranium supercycle. It's fundamentally underpinned by high-quality assets and a clear path to production growth, notably the Shirley Basin ramp-up expected in Q1 2026. The current price action, well below its fundamental valuation and technical averages, is primarily due to technical, mechanical selling pressure created by this arbitrage trap. And by its nature, this pressure is temporary. If the company executes the ramp-up as planned, the substantial analyst targets become entirely attainable once the technical indigestion of this financing is fully digested by the market.
And my view remains that the complex nature of this $100 million financing and the frankly poor governance optics, the insider selling paired with that inefficient $13.9 million capped call cost, they reveal critical flaws in capital management strategy. These decisions have introduced a structural ceiling at the 173 conversion price that will suppress the stock's growth and momentum for the foreseeable future. The positive macro narrative is certainly a necessary condition for success, but it is insufficient to overcome the substantial self-inflicted dilution risk and the ongoing high cost of this specific leverage structure.
Ultimately, the evidence really compels the listener to weigh the undeniable long-term asset value and the macro tailwinds against the harsh short-term reality of these market microstructure dynamics and the demonstrable corporate efficiency issues revealed by this financing.
Exactly. Both the fundamental bull case and the technical bear case are strongly supported by the recent data. It leaves the path forward highly complex, and it certainly provides much more to explore in RUG's filings as they transition into full production over the next year.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.